Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to host the next Hot Stock show with accomplished investor Roland, head of Stockopedia and the Dividend Note. So, welcome, Roland.
Good morning, Paul. It's great to be here. Thanks for
Yeah,
thanks
well,
for
we've
having me
had
on again.
we've had lots of big news on the corporate front over the past month or so, but we've always sort of dig into the details. I don't suppose you could quickly remind investors of what type of investor Roland Head is and what sort of quality stocks you look for.
Yeah, absolutely. So I would probably describe myself as a quality dividend investor. So I'm looking really for sustainable cash-back dividends from companies that have above average profitability, ideally. Within my portfolio, I'd aim to own a mix of high yield and higher dividend growth stocks so that the portfolio as a whole hopefully will provide an above average yield and also a decent dividend growth rate. At least ahead, at least in line with inflation, ideally ahead of inflation. Really, I suppose the idea is for me that the portfolio is a kind of progressive income generator where dividends are really the flywheel that drives progress and provides some kind of valuation benchmark and obviously also provides cash for reinvestment or for withdrawal as I need. Um, Personally, I like to think that from an ownership perspective, if you owned any other kind of business, you'd expect an income, and I prefer to have shares that also are able to provide an income. I think, for one thing, it's a lot easier to keep holding them when things go wrong in the market, or at least that works for me.
How
Uh,
important is a dividend? Because this is a big sort of like quandary for a lot of investors. I mean, I'm sort of more of a GARP investor, and I'm sort of indifferent. I prefer or I try and target a gross sort of return on a capital and an income basis. And if I see a good company that's not paying a dividend, it could may be able to pay a dividend, but wants to reinvest the proceeds with a higher return on capital than I've got, at sort of like 12%. How do you view that? Is it actually a must have or is it a nice to have?
yeah, I think there's obviously I think there's definitely valid ways of looking at it from both sides, but it's more of a personal preference, I suppose, that I'm not generally investing in aggressive smaller growth companies. So I think that if they're established, they've got that profitability and they've got enough of a track record, then I think that it's a logical discipline for them that I like to see that they pay out some kind of dividend, not always a high yield or not necessarily a high payout ratio, but something. And I do think it's a discipline too for management to have that allocation of capital that shareholders get some as well as reinvesting in the business, which obviously, reinvesting always carries risk as well as opportunity. And so I like to see that balance. It's a requirement for me, but as a choice, I wouldn't say that it's right or wrong, really.
Yeah. What about when you've got a really large dividend? When does that sort of trigger a large, alarm bells? So if you've got a fat yield of sort of like, I don't know, 8, 9, 10%, when does that become a sort of like an alarm bell, a real red flag for you?
Yeah, there are a few of those around at the moment, aren't there?
Yes.
Quite a few, surprising. But yeah, it's always a grey area. I think 8%, I mean, there's no hard and fast rule. 8% is probably not too alarming. If it gets to 10%, I would begin to think that either the market's completely wrong or else I'm wrong and that there is something coming down the
Mm.
line that could lead to a cut. So it depends on the business, though. Some businesses they're really not growing. They're throwing off a lot of cash. I suppose a classic example might be a tobacco, one of the big tobacco shares in the UK. Some of them, as far as I can see, they really can support high yields because there's not a lot else going on. Um, some financials seem to be able to support high yields too, and that's partly, I think, a valuation thing. That's the other aspect of it. Is it the payout ratio that's very close to paying out all of their earnings, or is there a valuation, an unusual valuation that's making the stock cheap? So I wouldn't have a fixed rule about it, but certainly I think as a rule of thumb, getting more than 7 or 8% is something that it's worth watching closely and keeping an eye on.
Well, you must be looking at the market with sort of like, you almost like, drooling at the market, given there's lots of companies with sort of higher dividend yields, and they've got even PE ratios at the moment. So there's certainly a lot to choose from. And just in terms of sort of the broader picture, there's been a lot of sort of corporate updates and trading statements from companies, particularly in the sort of the small and mid cap over the last 2 months. What sort of like the big takeaways that you could sort of like, highlight to investors that people should watch out for?
I think investor sentiment among small caps, especially, still seems maybe quite poor or a bit mixed anyway. But in terms of the actual results coming out of companies, I think it's overall, things are not too terrible. There are some patches of weakness. There are some areas that are a bit slow, and I think it's probably fair to expect more of that over the course of this year. But I think Halfords this week was maybe a pretty bad update, but you could argue that that's getting down to a level where it could attract some interest as a business. It's been around a long time, and I think the motor side of it is quite is developed quite nicely with the emphasis on servicing and so on in recent years. But yeah, I think the lesson really is that it's more of a stock pickers market, I think, than maybe it has been. Looking for companies, for me, focusing on fundamental health, good balance sheets, especially not too much debt with rising debt costs, and in cash generation. If a business looks in decent health, then I wouldn't be too worried about any short-term setbacks. If I was confident in the model, I think it's the time to look for opportunity as much as anything else.
Yeah. And are you fully invested at the moment? Have you still got some sort of cash ready to deploy?
I'm pretty much fully invested. I think I've got about 3 or 4% cash in my main portfolio that I'm kind of itching to spend. Really, I would say I'm still a net buyer at the moment. Definitely.
Yeah.
Yeah.
Well,
you too.
Yeah, well, I've actually got a bit of cash to deploy, so I'm still looking for opportunities. I'm hoping we can sort of pick up a few here. Now, if anybody wants to ask questions to Roland or myself, then please just put them into the box and type them. We've got two already, just on a company that I know reasonably well. It's Avacta from James Carrain. First of all, he asked me, have you got an interview lined up with the CEO, Alistair Smith, of Avacta, after I've just done their 35 million. No, it's 32 million pound placing at 50p. I haven't actually, and the reason for that is that because they've raised money through UK investors, and US investors, this is actually a blackout period. It's split into two. There's a first sort of like firm placing, which is majority of the funds, or about half of it. And then the other rest of it is dependent on a general meeting, which I think is on the 18th or 19th of March. So hopefully by April, I'll be able, that blackout period, which I think is 40 days for US investors, I'll be able to have an interview and to bring a lot of the information in terms of that placing, what the proceeds are going to be used for, and the drug development pipeline, both in the Precision platform and the AFMA platform. And the second question he had, because it was a two-part one, was that why was it done at 50p? And I can understand the sort of like the... What's that? Ah! Sorry about that, gents. Was that... that was me, I think it was, wasn't it? Let me just put in the... oh, sorry about this. Let me just put in the right screenshot. I know what that exactly was. Did anybody hear that? Roland, did you hear that noise at all in the background?
No, I didn't hear
okay,
anything.
that's a relief then, because I was trying to screen share, and for a strange reason, I screen shared tried to screen share the YouTube. So that was my mistake. But anyway, I've just come onto the Avacta chart, and as everybody see, the shares have actually dropped quite heavily over the past ahead of the placing. The big picture is that it's quite difficult at the moment, as people might imagine, for small caps, particularly sort of pre-profitability, to raise sort of like 30 million plus. And a lot of companies can't even raise any money. So it really is a sort of like, it's an incredibly tough market to do so. The big picture is that they have done, and this should fund them for the next 2 years in terms of actually doing their pipeline development. So it'll give them the platform to do the phase 2 trial efficacy for their AVA 6000 for their smart chemo drug there, and likewise to do hopefully the phase 1 for its next precision candidate, the AVA 3996, and also progress the third candidate as well to decide to select it, to take the company funding through until really the start of 2026. So that's really what it's used for. So yes, it's been painful, but big picture wise, the market cap is what, £200 million. This is a multi-billion-dollar market, and if they can get the products to to be approved and to into market with smart chemo, then the 50p will see him a long time ago. So yes, it's definitely no doubt about painful. But anyway, I hope to get a bit more detail from the CEO sometime in April. I guess you don't invest, Roland, do you, in sort of like small cap biopharma type shares, which are they've got revenues, but they're pre-profits.
No, this is yeah, I have to admit this is well outside my comfort zone. Avacta. I don't know a lot about it, but no,
Okay.
it's not one for me.
Okay. Well, let's move to one you do know a lot about because you used to own it. Was the is Direct Line, which got a an M&A bid from a trade buyer over in Belgium, I think, Aguias, at about it was a cash and stock deal about 233. So and the shares shot up. What's your latest on this one? Because it's really, if you're a long-term investor, what do you decide to do? Do you decide now to check out at a ticked up price, as people can see, or alternatively, would you sort of hold because there's a bigger gain? Because the board of I think rejected it unanimously, the bid.
Yeah, that's right. I think it's yeah. I mean, it's interestingly the offer came out at about 233p a share. I think at the time it was announced, with 100p in cash and some new shares as well. Funnily enough, that seemed to take the share price pretty much back to where it was at the end of 22, before Direct Line had to cancel its final dividend for that year, when it was hit by some big losses on motor claims and weather-related property damage. So I think the business well, there's no doubt the business has struggled with growth in recent years. And in my opinion, I think for a period it wasn't very well managed. I did used to own it at the time, and that was one of the reasons in the end, I cut my losses. Having had the offer now, I think I might be inclined, if I still held the shares, I'd probably be inclined to continue holding them now. I think some of the problems they've had with pricing and IT are now probably being fixed. There's an experienced new chief executive who's about to start. They've restarted dividend payouts, and although it's at a lower level, the yield isn't too bad all the same, because as we were discussing a minute ago, it had really reached quite extreme high levels before it was cut. So my kind of concern with this business really is whether the emphasis on the direct model works quite as well as it used to. I know price comparison's been around a long time now, but I used to think that the brand was, I think maybe the brand is not quite as strong as it was, but it maybe is an opportunity for the new CEO to really to restart that growth. So yeah, I think if I held it at this point, having seen interest from a potential buyer and changes at the business, new management, I'd probably continue to hold for a bit longer. But I suppose I'm not quite inclined. I'm not sufficiently excited to consider going back in. Not at the moment, anyway. I think I'll have a look after the new results and when we've heard from the new boss to see what the situation's looking like.
Yeah, I would do exactly the same. I think I think most investors can correctly assume that if Aguias has gone public on the deal, going around the actual board, and obviously in the absence of they've only got now a CEO who I think arrived today. What that says to me is that the Aguias are dead keen to do a deal, and they're so keen that they've decided to go straight to the major institutional shareholders. So if I was owning it, I would definitely hold, based on the assumption that I think eventually they're going to improve the offer, increase the level of cash in that 233 from a £1 to something more acceptable. So I think it's just really sort of like really negotiating price here.
Yeah, I think they're just dipping, kind of they're making an initial play, and it probably is a bit opportunistic, the price.
Mm.
So yeah, I think it's a positive sign for anyone
Yeah.
for the shares.
Good. Okay. Well, let's move on to a different sector, industrials. Let's go to probably right top of the food chain, Renishaw. I'm really fascinated on this company because I have never understood the valuation, but equally, I've never really understood the technology. Could you enlighten us on this one, because it's trading at, if I get this right, it's trading at roughly around about nearly 30 times PE, and the shares have always been extremely well valued. What's the investment case for this business?
Yeah, I think it is one of those stocks that's always looked expensive, and I've never quite managed to persuade myself to buy the shares really for that reason. But so what they do, I suppose it's a very clever, very clever British engineering business. What they do is make equipment for use in situations where very high precision is required. So things like measurement probes, calibration, machining complex lightweight parts, robotic platforms for brain surgery. I think they've got something that's a newer product. Very high-end additive manufacturing, which is what they call 3D printing. So there's a lot going on. It's very clever. It's quite a long-term business. It's still um, run or still controlled by the founder, Sir David McMurtry. And client customer sectors are areas like manufacturing in automotive, aerospace, semiconductors, and healthcare and science. So quite a broad range. Like I suppose, like a lot of other industrial businesses, they did see some softer demand last year, and the results kind of dropped back a bit. I think the business has also been investing in some longer term growth opportunities. So the shares, the recent half year results were very well received, even though revenue was down 5% in the half year. And I think the growth, the investment case really is that over longer periods, this has proved to be a good quality compounding business with a lot of genuine innovation, differentiated products, well regarded well regarded by its clients. So it's the shares. I mean, the PE ratio nearly, as you say, nearly 30. It does look high when you look at the dividend yield is below 2%. So
Yeah.
really, for me, that is a bit low. I was a bit disappointed actually at the way the shares rocketed up when the half year results came out, because they were below £40 before that, which
Mm.
seemed to me more of a decent level of opportunity. But yeah, it's a good quality, conservative, innovative business. I think that if the future's like the past, then it will create more value, should create more value over the coming years and decades for its shareholders. So a patient holding business to hold, I
Yeah.
think, and be rewarded for
Yeah.
that.
Is this a sort of trophy asset in the UK end or specialist sort of engineering instrumentation sort of sector? Because it always seems to have this sort of takeover premium, even though people are never talking about it as a target. I do wonder whether a Danaher out in the States, or a Honeywell, or somebody like that who do lots of instrumentation would pick this up, because it's a good size, 3 billion market cap, and it makes 18% EBIT margins.
Mm.
So, I mean, is it something that if it was bought by a bigger sort of like conglomerate, with similar sort of technologies, you could really leverage the technology over a bigger footprint into more customers?
Yeah, I think that's possible, and it is probably cheaper than some comparable US businesses might be. And funnily enough, it was the company did put itself up for sale.
Oh,
I
did
think
it?
it was 2021, and the shares shot up to about £60 then. But the the controlling shareholders didn't seem to find a suitable buyer for whatever reason, and the sale process came to an end. But so that the founder is in his 80s now. He says he's still committed to the business, but I think it's not unreasonable to expect that one day eventually it will be sold. I, I'd guess at a decent premium to the current price, I would have thought, unless something goes wrong in the meantime.
Mm,
But that's yeah, obviously only speculation. But
yeah.
yeah, sale it has been talked about as a possibility before, and I guess it could happen at
Mm.
some point. But
What
it's
price? What price would you buy it at, Roland? Because I'd probably go for
Well,
the same one. A dividend yield of what, 3%?
yeah, well, 3%, I would definitely be buying it. I would
Okay.
definitely see that as a buy. I think I might go a bit lower than that. But I can't, yeah, I'm not sure about less than 2%. That's really a bit low. But the shares were down as low as £30 late
Yes.
last year. And even until these results came out a couple of weeks ago, they were below, around 35. So there has been some movement, and I hope, I would, if I saw another opportunity like that maybe later
Mm.
this year, if sentiment is poor and if the recession kind of mentality is sticking around, or if demand is soft still, then
Yeah.
perhaps there'll be another opportunity to pick them up.
Yeah.
It's difficult to know because it's one of those cases where you might argue, if you're a pure quality investor, might say, well, it's high quality, just buy it at any price and forget about it, and you'll be rewarded. But I struggle to go that far away from looking at valuation as well.
Well, there's lots of really high quality stocks out there, cheaper, isn't it? So you sort of like you're
Yeah,
drawn
that
to
as well.
those. But I
There
would,
are
but I,
others.
I would highlight. I think it's a great strategy there, Roland. I would highlight to investors when you come across absolute top notch businesses like this in Renishaw, put them on your watch list. When they drop down, reach your target sort of buy price, then pick them up at that time. Be disciplined, but you can. That's how you upgrade your portfolio over the long term, because the market invariably hands you gifts occasionally. And so you just need a long list of really good companies that you can buy at acceptable prices. So certainly to do. Another one which is worth considering, which came out news this week, is Avingtrans. And the reason why I mentioned this, it came out with interims. Let me get the chart up. And this one sort of ticked down. This is a specialist engineering business that does sort of like niche products and services, things like blast-proof doors for HS2. It does storage boxes for low-level nuclear waste for Sellafield, big part into nuclear, both on the life extension, the decommissioning, and the new build into the small form. And the reason why I mention it is because this is one where you should look at it on a sum of the parts value. It's got a sort of like a buy and sort of build strategy, but does exit as well. And the main sort of core assets are all in this engineering business. And I'd done a valuation of using sort of like, used 12 to 14 times EBIT and come to sort of like well over £4. And you can see the shares only 3.99 at the moment. So you're getting everything else for free. And everything else is they've got some land which is worth about £10 million plus. This is a market cap of roughly 120 million. So it's nearly 10% just on freehold land. And they've got this sort of like, quite exciting medical business that is doing small form MRI scanners and X-rays. The X-ray scanners have already been approved by the FDA last year and have been marketed into the doctor surgeries and also into veterinary practices already. And the MRIs are about 12 months later. They should get FDA approval later this year, and they'll go into a similar sort of market. Plus, they've got a new application in industrial sort of scanning for precision parts and stuff to test sort of manufacturing deficiencies. And so if you put all that together, well, it's difficult to know what the medical side is be. But if it was actually successful, then I would not be surprised if the medical arm, given that it's got patented technology in really high growth areas, and these are addressable market of well over $7 billion just in the X-rays, never mind the MRI side. Then you could get a sort of 100. You could double the shares and get 150 million market cap out of it if it went well. So that would take it up to about £9. Now, all I would say is that's sort of how to look at on a sum of the parts. But again, it's one of those top quality stocks, and if you see it over time, if you did it over 10 years, let me just put that chart up. You'll see how it's just been one way traffic all the way up from. And if you go back even further to 2010, it's gone from sort of 30p to like 10 bagged, more than 10 bagged in that time. So it just shows you sort of the returns if you'd stuck by the sort of the management team. I don't know whether you've ever looked at Avingtrans at all, have you, Roland?
No, I don't know a huge amount about it, but I think one thing that struck me looking at it, it's one of those shares where when you look at the reported metrics, if you're using a service like Stockopedia or so on, and you look at the operating margin and the return on capital, they don't seem very impressive. But clearly, when you dig in a bit more deeply to the business, there's a lot more. There seems to be a lot more value creation there, and a lot more quality than is first apparent. So it's a good example of where extra research can really pay off. And I think from what I understand, the management are keen to. They do expect to make further exits from some of their subsidiaries, whether that's some of the medical businesses, hopefully, and this does seem like it could create a lot of extra value
Yeah, yeah.
for
Well,
shareholders if that takes off. And obviously, good balance sheet and some freehold property is always nice to have as an underpinning to really protect you from worst case scenarios, isn't it?
yeah, no, I totally get it. One question coming in from Revs 8. I hold two industrial turnarounds that appear to be back on track, Renold and Costain. I don't suppose you've got any view on those ones. I think Renold's the industrial chain mining maker, also does conveyor belts at airports and for other applications. Then Costain's is obviously the big infrastructure stroke construction firm in the UK.
Yeah, I think Renold doesn't pay a dividend, and I haven't ever looked at it really closely for that reason. But no, but more seriously, yeah, I actually have I think I have a fairly positive impression of that business too. It's from what I know, it's kind of a market leader.
Wow,
Good
look at that.
good customer, good market share, good quality products. It is quite a differentiated niche engineer, and I think it's a nice business. I'm not sure I have much insight into the outlook, but yeah, it does seem to be back on track and doing okay. And I think one drag on the past may have been pension issues, but
Yes.
whether that's improved now, perhaps. Um, Costain is a funny one, well, because it does seem, I've followed it on and off over the years, and it's kind of gone through good and bad patches. But one thing that seems to happen is that periodically they need to raise a bit more money, and you often look at it and they appear to have a massive net cash balance, and everything looks good. But I think it's one of these businesses where net cash is really not surplus cash. They've got to have that financial strength up front to be able to win large contracts and to be able to get big projects underway. And when you look at the share count, it's more than doubled since 2017. So it's a type of business I think that can do well when things are going well, but there's always that risk with these companies. They operate on very thin margins, and any sort of slight mishap or change to external conditions can be painful. I'm sure probably the contracts are maybe being structured more carefully now to pass on costs and so on. But for that reason, I don't generally invest in that sort of in the construction and sector, really, just because these businesses seem to have periodic troubles, even if they're relatively well run and well founded.
What's really interesting is in terms of whether it is a value play or a value trap, because this is the Costain's charts, etc. Now, these are actually probably these PE ratios that you can probably, I'll just put them up a bit bigger. We've got a PE ratio of less than 7 for this year. Let me just make it sure it's a bit bigger. And but we've got basically a here it is, PE ratio of, oh damn, I'm trying to get it right. Yeah, PE ratio of less than 7 and a dividend yield of 2% for Costain. So what you would say is that it's really cheap, and this is done on reported earnings, rather than actually sort of adjusted earnings. And it's got, but how would you view that? Because if it's got it's got reasonable cash, and it's only got a 2% yield and is really low PE, that does say quite a lot, doesn't it? Because you're right, there's lots of balance sheet movement with working capital there, presumably.
Yeah, when I see a really low payout ratio like this from a company that appears to have loads of cash, then what I generally ask myself, either is the current profitability exceptional? Is it going to fall back to a more normal level? Or is it just that the company needs to hold on to all that cash and it isn't really surplus at all? And looking at kind of cash flow data for the last few years, it seems to be fairly mixed. You get some very cash generative years and then some years where the company consumes cash. So I'm surprised that the payout ratio is quite so low still in the forecast numbers that I can see as well. But I would
Yeah.
probably take that as a sign of well, prudence on behalf of the management. But maybe the low PE ratio is not as attractive as it might seem, or that would be how I would
Yeah.
probably view it. I wouldn't put it this way. It's not a stock you'd expect to see on a high P ratio, probably not when it's trading, during a good period at any rate.
Mm. Yeah, I tend to go. I prefer sort of companies with better operating margins. If it's 2 to 3%, it doesn't leave much for margin of error, does it? If they get things wrong.
No, and
What?
not especially when business can be so lumpy with a
Yeah,
relatively small number of very large contracts. There's not
yeah.
that safety from lots of small transactions that you can.
Mm. If you want to, if for just for investors, there's one stock if you're interested in, which I don't own, but I know a reasonable amount, which is a plant hire firm, which serves the likes of Costain and people Galliford trying this. It's called VP. It's controlled by it's about 50% owned by a family, and it's trading at ridiculously low levels at the moment as a sort because it's been sold off with all sort of like construction and infrastructure type stocks. But what it does is sort of like a long cycle and short cycle plant hire. So it owns Brandon Hire Station, the tools one which competes with Speedy Hire. It also owns UK Forks that does obviously forklift trucks and does forks for building construction, and also does Ground Force, which does sort of trench supports and stuff like that. Hires them out to things like people who do tunneling for HS2 and this sort of stuff. The shares have dropped significantly, but they trade currently on a PE ratio again of less than 7, on an EBIT ratio of less than 7, and they've got a reasonable, sort of balance sheet for a plant hire firm, i.e., they're backed by a lot of assets, etc. And they are seeing it is obviously difficult in housing, no doubt about it, and in sort of commercial property with buildings, but they are seeing good growth in infrastructure. So things like the water companies having to spend a lot, also transmission with the upgrading to electrification, plus obviously transport with the rail network, etc. And that's where the big exposures are. So they're just going through. The market is obviously a bit soft from where they are, but if you want to sort of like a long-term value accretive share, then this one, over the long term has done very well. Not recently because it's just been sold off, but that's actually hiding a lot of performance. It looks to me fundamentally undervalued. But I don't know if you've ever had a look at VP at all. It pays a reasonable dividend actually. It's a 7% dividend
Yeah,
yield.
I'd say it's a PE of 7 and a yield of 7% at the moment. And I think looking back at the record, I don't think the payout has ever really been cut for
Yeah.
the best part of 30 years. So actually, yeah, this is a business. I did look at it a bit last year, and I think I do like it quite a lot. If I was going to buy a business in kind of plant hire or construction, it would
Mm.
probably be this one. One of the things I like in terms of the hire business is the way that they focus on quite a few niche areas. So not just the general
Yes.
hire equipment, but stuff like I think temporary roadways, kind of specialist compressed air machines, surveying equipment, shoring and piling and stuff like this. And some of these things where there's a bit more differentiation, a bit more added value, I think. And as you say, owned by the family for a long time, a sensible balance sheet. And I think about 40% of work is from infrastructure. So that hopefully reduces some of the cyclicality from other types of construction. So, yeah, no, I think it's a good business too. I quite like it. And it does have a good record of rewarding shareholders, perhaps because, of course, the controlling family own about 50% of the stock. So
Yeah, and it's
that's always a nice thing to see.
Yeah, and I think a lot of people get put off by the debt, but actually, if you look at it on an EBITDA debt on a forecast basis, it's trading at about 1.2 times, which for a plant hire firm, because it's got so much asset backing, it owns the equipment that it hires out, is actually fine. Because if it decided it wants to turn off its new capex, then you'd get just the cash would come straight out of the business, really.
Yeah, I normally look at these sorts of hire businesses as looking at debt up to about 50% of the fixed assets being
Yeah,
that sort of balance being quite comfortable and normal,
yeah.
really.
Yeah, good. Okay, well that's great. Another one which is sort of like the shares have seem to be sort of unfairly treated. You've got is Robert Walters, which is the sort of the global international recruiter. Don't know if you want to sort of take us through this one because I was looking at the valuation and it's I mean not surprisingly people are a bit nervous in terms of the recruitment sector, but it's pretty cheap, isn't it? Actually, it seems to
Yeah,
have recovered just of late from that bottom in October.
it has. Yeah, it has come up a bit. I think the shares were down to about 350 in late summer, kind of August, September time last year, and again in October, and they have come up a bit. But yeah, this is, as you say, it's a recruiter. It's a 300 million market cap, and it's I think its main specialism is professional services, so a kind of accounting, finance, and that sort of thing. Um, I think it's quite a good business with a pretty steady record of growing kind of through the cycle. So I don't know, when you look at a really long-term chart, so at least say 20 years, you see there's been quite a bit of volatility, but
I'll
there's
give you
been an
30
underlying
years there.
trend. Oh yeah, that
I
would be
know
good.
there's
Yeah.
20 years. There you go.
Yeah, so you can see that, underlying all the volatility, the general trend has been upwards. And for shareholders who've bought at lower points, where I think we probably, which I would say we might be at the moment, there's been plenty of good dividends. It's a highly profitable business in terms of return on equity during the good years. It throws off lots of cash. So I think it's one of those cyclical opportunities that if you can time it right, you get to benefit from a nice re-rating and a recovery in income. There's never any guarantees that these, of course, but that's roughly how I view this at the moment.
Mm.
The founder, Robert Walters, did retire not that long ago, so that's perhaps one factor. But the person who replaced him, I think, is quite a long-standing executive in the business. There's good continuity, I think.
Yeah.
I don't think it's too much of a concern.
Mm. Yeah, that 40p back in 2002, 20 years ago, was a buy of a lifetime, wasn't it?
Yeah.
When you can get these cyclical industries. But you're right. I
Yeah,
mean,
although it's not always easy, is it? I suppose to keep holding on when you get
yeah,
the peaks and the troughs, you've got to be confident in the business
yeah.
to watch it come down and then wait for it to go up again.
Yeah. Well, I just say with an EBIT, an EV, because it's got a lot of cash, this thing. It's got sort of like nearly 80 million of spare cash. So if you strip that out and do an EV to EBIT multiple, you get 8 times, which is not expensive. And a 5 times, 5% dividend yield on reduced cycle earnings is a pretty good valuation. One thing I would have with the recruiters, just as an open question, I guess, I don't know if you know this one, is how are they going to be impacted by AI when it gets sort of like, when they go through scraping social media and LinkedIn and this sort of stuff? How easy or difficult is it? Will the recruiters sort of like respond to it?
It's I don't really know. I mean, it's like you say, some of the initial research and sifting maybe could be automated, but is there still going to be value in human relationships, networks,
Mm,
face-to-face conversations? I think there probably will be, at least at a higher level. At any rate, I don't think, but it's anyone's guess really at this time.
yeah. Okay,
Um,
good. Okay, well, let's move on. We've got a question coming in from Matthew Roberts asking about the Forex issues with Nigeria, which is a perfect opening for one of the companies that I know you've had a look at is PZ Cussons, which is a bit of a darling in all things sort of like FMCG brands, things like I think owns Imperial Leather and Carex. Got a good business and it's cash generative in the UK, but about 30% of it historically has been out in Nigeria, and it took an absolute bath with a trading update just recently. And I believe it had held a lot of local currency, the naira, and it couldn't get it out, and therefore the devaluation meant that net cash went from being a lot of money to confetti overnight. So it was,
yeah, I mean this. Yeah, I don't mind admitting this is one of my worst performers for a while, and I do
yeah.
hold this share.
Oh, do you?
Unfortunately.
Oh,
But yeah, no, what's happened, I think, and as you say, they had quite a lot of cash in Nigeria that, like a lot of other multinationals, the cash was stuck there. They couldn't repatriate it because they couldn't get enough dollars in Nigeria to get the currency out. And then the devaluation came along, and as you say, the money in Nigeria is not worth as much. But one thing that's maybe made matters worse is that the Nigerian business has quite a lot of payables that are denominated in US dollars, so they've still got to be paid in dollars, and the cost of doing that has gone through the roof. So
What's
there
that?
was
Is that basically the supplies from the UK? They're manufactured in other plants around the world and then shipped to Nigeria for them for distribution.
well, I'm not sure if they're actually shipped to Nigeria or if they're just purchased on US dollar price agreements. I don't. That's a good question, really. Whether
Yeah.
they, I mean, I know that most of this is, yeah, it relates to input costs to suppliers, these payables that are denominated in dollars, but I'm not sure where the inputs have actually come from. But so, yeah, I mean, in the first half of the year, their financial year, which was until the end of November, I think, um, the revenue was down 18% because of the devaluation, but there was an 88 million pound foreign exchange loss, and that's really going to have to be paid in cash in the end, as far as I can see. It's not just a paper or hedging thing. So they cut the dividend as a result of that, or they cut the interim dividend to maintain earnings cover, and it's not a great situation. But I suppose there's a couple of things that mean that give me some kind of that I think are still positive. First of all, the consensus seems to be that the changes going on in Nigeria are positive and could lead to an improvement in conditions for foreign investors if if they can get to the other side of this, I suppose, and control inflation and stabilize the currency and so on. There's meant to be, I mean, PZ Cousins said in the recent half year call that they are seeing better availability of dollars now. They actually are having more success in getting money out of the country, although obviously some of it
The low level.
some of it is now not worth as much as it was. They've been buying out. They've used some of the local currency. They're using some of the local currency to buy out the remaining minority shareholders in their Nigerian subsidiary. So that is kind of an effective use of some of the local cash, I suppose, and helps to simplify the business. And as you say, they've got quite a few decent brands that are mostly trading well outside of Nigeria. Well, they're trading okay inside Nigeria. It's just the impact of the devaluation. So I'm kind of, prior to all of this, I suppose I would have said that what I was looking for from this was was some improvement in profitability, because although it's a nice consumer defensive business, it's not been as profitable as, say, companies like some of the bigger companies like Unilever and Reckitt in recent years.
It's 11% EBIT margin, which you're right is almost half actually.
P&G. So now, I'm inclined to think the shares probably offer some value now, if you believe that the situation in Nigeria is the worst is probably over, and the business itself is operating and doing the right things. But obviously, it's not without risk, and there's no guarantee in a place like Nigeria that the things couldn't get worse. So,
what would you do if they cut the dividend or cancelled the dividend or suspended it? Because it's actually quite given they've now got a pretty chunky, nearly 97 million pounds of net debt forecast, but they are paying a 4.5% dividend yield. You do wonder whether that's going to come under pressure.
Yeah, I mean, the interim payout was cut to 1.5p, which was actually a reduction of 44%. So right. That was a big reduction. And if the final payout is reduced at a similar level, then there's already a big hit to the income. I suppose really, I probably, knowing me, I probably will wait till the full year results come out, or at least till there's some update on trading in the second half of the year, to see if the situation has stabilized or improved at all, or if I think things are going to get worse and the business will just lose its ability to pay a dividend, then I might consider getting out. But it's been a business that's been around for a very long time, traded in Nigeria successfully for a long time, and I'm suppose at this point I'm inclined to stay patient, having taken the hit, taken quite a hit already. I think it's worth holding on, but that's it's not always easy to know whether to react quickly, I think, with these things, or whether to be patient. I tend to be patient, but sometimes that's the best option. Other times it would have been better just to get out and ask questions afterwards.
Yeah, and I think one thing about, given that the share price has fallen so much and it's got sort of iconic brands, then it's probably going to be a target for M&A, isn't it? It's like people are going to be looking at it and thinking, maybe I can snap this one up. But it also goes to show that even if you've got an FMCG apparently stable, sort of like pricing power type business, which you'd every day of the week you would typically buy, you say your units, your recommend keys, as your P&Gs, it still could halve, can't it? It's just that's the part and parcel about, because it's risk. When you put money into the equities, it's risk capital.
Yeah, absolutely. And with this, I suppose, it's you could look at it, you could have looked at it, you could have looked at it and said, well, operating in Nigeria, it's not the safest market. It's not like Australia or the UK. But even then, there's no guarantee that approach would solve the problem. I mean, there are some businesses closer to home that have had a bit of a shocker recently as well.
Yeah. Is there any other companies that you might think of, or sectors they might think of, that's got exposure to these emerging markets that have big devaluation? I suppose the ones which you could potentially get it would be South American or other elsewhere in Africa, or maybe out in Asia as well. I don't know.
Yeah, I mean, actually, I'm you mentioned South America. One company I think we talked about previously in another video was Inchcape, there's a car automotive distributor. They do a lot of business in Latin America. That's quite a big market for them. And so I suppose that's a situation where you could see that kind of impact if conditions changed dramatically. But I think there's always some risk when you're in emerging markets. But then again, a lot of these businesses have been operating in these regions for a very long time, and they do understand them well. It's there's always the external risks that you can't predict, aren't there?
Yeah, that's right. Yeah, and we shouldn't get too, sort of like no sniffy in the UK, because if we get Liz Truss winning the next general election, then we might see another dive in sterling. So I mean, I remember that touched. I think it went slightly below £1 to the dollar, didn't it? When at the time of that peak.
Yeah, I mean,
prices.
it was scary for a moment. But I suppose one other point about PZ Cussons is not that it's unique. Lots of other similar companies have had this exposure, but they aren't as heavily weighted to Nigeria as this business. Like you said, it's about 30% of the business. But if you've got companies like, I think, Unilever, GSK, and big names, they're also exposed to it, but just on a much smaller proportion of their business. And that's maybe something to consider too, the geographic exposure. But whether it's how concentrated that is can make a big difference.
Yeah. Okay, good. Well, let's switch sector to animal health, because another one which came out with news this week. It sold one of its subsidiaries, is Animalcare, and it was an incredible sale. It's for about I think it was £25 million it collected to sell its microchip for cats and dogs service to private equity, and it was only just really just very marginally profitable. Anyway, the shares have shot up. The reason why I mention it is that it's a high quality sort of like farm. You'd say it's a pharma company, but it's an animal healthcare business that does drugs for and treatments for dogs and cats. Companion animals is about 70% of it. I think it also does for production animals, cows and pigs, was about 20%, and the final bit is horses, I think, as well. And they do pain relief, dental treatments, and they're also going in. They've got a partnership with a company out in Holland, I think it is, to do antibodies for arthritis and stuff like this. So this is quite a high margin business, sort of 14%, but it's got a lot of scope to go much further, those margins. I mean, the sort of the poster child in the sector is Zoetis, which it trades on about 28 times EBITDA. Has got margins of nearly 30%. So if they ever got anywhere near that, this trades on about 8 or 9 times EBITDA. But because it's now got the cash, it's got £27 million of net cash. Market cap is around about £135 million. And again, this is another really good, high quality business. The reason why I sort of came across my sort of like path when I interviewed Christopher Mills of Harwood Capital, and he mentioned that he liked it and really rated the CEO Jenny Winters, and I own a small stake in it. I bought about 6 months or a year ago. I can't exactly remember because I didn't have much cash at the time. But again, it's another good one, and I think the thing which I like about it, it's got pricing power. So and its non-discretionary expense tend to be because people, there's 60% of households have companion animals, and they don't usually scrimp and scrape on their animals. And also the pipeline in terms of developing drugs is a lot easier and less onerous for if you're developing new treatments for animals than it is for sort of humans. It means it's far less expensive. Plus, there's less competition when it becomes off patent and goes OTC, over the counter. Then there's less competition in the pricing. I don't know if you've ever had a look at this sector or got any comments on animal care. Have you at all, Roland?
It's not something I know a lot about. I know that, like you, a lot of these businesses supporting the vet sector or in the vet sector have done really well over the last few years. I think, yeah. So animal care, they've just had a big chunk of cash from the sale of a non-core business, haven't they? But
yeah.
no, it's not something I know too much about.
It's not cheap, and it pays a 2% dividend yield, but I think it's a real high quality asset that is going to go on a buy and build strategy. I did get one question in the area from Steve Waters here for you, Roland. Do you know anything about CVS Group at all, which is the veterinary practice? I know they've got that CMA. Didn't they have results out just recently? I think it was. You don't know anything about
it? No, I know, like you say, yeah, I know the shares were really hit by the CMA announcement, but and I don't know if much has happened since then. It's not much of a yielder, so it's not something I follow really closely. But again, I know it's been very successful and delivered really grown strongly for quite a long time. One of the bigger AIM stocks and one of the better AIM stocks probably.
Yeah. I think it's one which is difficult to say until you start seeing the review from the CMA. Another one in that sector, just to sort of tie the bow on it, is Anpario, which does specialist animal additives for feed. So this goes in. It's sort of all natural. And it goes into to help sort of digestion and improve the immune system for animals, to improve, and also to take out the antibiotics as well. This is another one which is sort of like a high value business, well, in terms of the quality of its products, but it is only making to 10% EBIT margins, and the idea, the trick is there is for it to grow going forward. But again, I think these are good sort of quality assets, Anpario and Animal Care, that people want to put onto their stock. Which, I mean, you can see how it's come down. It's halved over the last 2 or 3 years. It trades. It's actually got about a 4.7% yield actually, and got 10 million of cash. Again, have you had a look at this one? Market cap, I mean, 45 million.
It does seem to throw off a lot of cash, and I noticed they did a tender offer last year, and they bought back 9 million shares, which must have been about 20% of the share count, or maybe something in that region. I haven't done the exact sums. And as you say, there's a good yield. I suppose what struck me having a bit of a look at it is that growth seems to have been a bit inconsistent and not that, there doesn't seem to have been a very strong growth trend for the last few years, and revenue seems to be stuck at around 30 million. But yeah, I can see what you say about it. It does seem a decent business with nice margins and good cash generation. I can see some attractions here if they can just get if they can find a way of getting a little bit bigger, then I think it could be worth more.
Yeah, I think the other thing, they are pushing up prices, because I think that margin, the 10%, has been sort of like, temporarily depressed because it's taken a bit of time to reflect the raw material costs into the prices. So that's sort of like happened. That's the one thing about, whether in pharmaceuticals or in animal care, which is more sort of, animal care, so to speak, is that they've got lots of pricing power. So if you actually have to increase them, then you can do that. You can pass that on, which I think is going to be important in a less inflationary environment as we go forward, I guess.
Yeah, I mean, I think the margins were sort of 15 or 16% prior to the last couple of years, and so there is obviously probably does seem to be the potential for a bit more.
Yeah.
a bit
Oh,
more there, and that could drop through quite nicely
yeah.
to shareholders, I guess.
Yeah. Right. Well, I've got another cheeky question for you, here, Roland. It's from Lemon Physical, and he says, what's your latest on IG Group? Because I know you were a holder of this, and it's we've had good read acrosses from CMC Markets and Plus 800. So I'm guessing these guys are going to do pretty well.
Yeah, I think IG, the last set of numbers that came out, the business, they, like everyone, they've seen a drop in activity levels with market conditions, but that's really to be expected. And fundamentally, yeah, it's still in good shape. I think the shares look pretty decent value to me
Mm,
at the moment. With there's a yield of 6% that's covered nearly twice, nearly two times by earnings.
yeah.
So plenty of support there, plenty of cash. And I like it because I see it as the highest quality and the largest player in this sector. So I think that gives it some attractions in a sector where there's a lot of regulatory risk and various other things. I think it's nice to be in where I see as
Mm,
the best of the bunch.
yeah.
Um, some of the one thing I suppose that's notable about it, they've put quite a lot of effort and some capital into expanding into new markets in recent years. I suppose the core leveraged trading business has maybe got a natural limit in terms of in the UK and in the other markets where it operates. But so they've got the options trading business, Tasty Trade, in the US, which was probably quite an expensive acquisition. I think it was $1 billion they paid, maybe at the peak of the market a couple of years ago. But they're a bit reluctant to break out profitability on their segments, but as far as I can see, it is trading profitably and it is growing still. And higher interest rates have also provided a nice boost to earnings to offset some of the drop in trading. So yeah, I think IG looks in good shape. I hold the shares and have done for quite a while, and I think at the moment I wouldn't. I would see it as more of an opportunity than anything else. I think
Mm,
there's hopefully scope for further growth. They have just got a new chief executive, so it'll be interesting to see what he says about the business and when he's had a chance to get going.
mm. The regulation actually is a double-edged sword because yes, it can put more onerous conditions, but actually it stops new entrants coming in or any weaker players because they've got to upskill. If you go with the best horse in the race, then they can absorb the extra costs, whereas the lower levels just can't take the regulatory compliance.
No, I mean IG is the biggest and out of those three that we tend to talk about in the UK. And as you say, that's tougher regulation is in some ways an advantage
Mm.
for the market leader because they're best able to handle it.
Yeah. Yeah. Well, I mean, the only thing is to say, I thought their profits might have taken a kicking with Paul Scott deciding not to do spread betting anymore. But anyway, okay. Well, let's move on to one of the other consumer products, which is Ultimate products that I know that does sort of like I think it's kitchenware and homeware and stuff like that. What's the sort of the attractions here?
Yeah, so they own brands that are like things like Salter and Beldray,
Mm.
and that are quite well known and have a long heritage in the UK. And they all this stuff is produced in China, I think, with contract manufacturers and shipped over here. And it's a business that's done quite well since its IPO. I can't think when it was. It was a few years ago now, but
One of the few.
one of the few, yeah. And I think it's well run. The board own the chief executive owns just under 10% of the shares, and the founder is, I think, the chief commercial officer and owns about 20%. So there's plenty of skin in the game. Um, Really good profitability, I suppose, because it's quite a capital light model. They get return on capital employed last year, I think, was 28%.
Wow. Yeah.
Operating margins are now just about into double digits, and they do seem to throw off plenty of cash. And there's a 5% yield that looks quite well supported to me. Another thing I like about this at the moment is that a lot of companies have talked about destocking and supply chain issues, and either from being on the receiving end of it from their customers or from doing it themselves. And one thing Ultimate said recently was that they think destocking in supermarkets and other major chains is nearing an end, that the comparatives are going to become a bit more normal. and big customers, they're seeing their big customers like supermarkets return to more normal ordering patterns, being more open to taking on new stock now that they've destocked a bit. So it seems to have been a business that just trades well. It's reasonably valued. It's got nice profitability, and it pays out what I would see as a kind of sensible sized dividend relative to its earnings and its growth opportunity. So I just think it's a nice business with some decent brands that give it a little bit of an advantage in its, at least in the UK anyway.
Yeah, I mean, what is astounding? I've never really looked at it before, but we obviously were all locked down. We had that was the COVID bottom. It then rallied clearly as the world sort of got back, but because it was selling, sort of homewares that people wanted to spend a lot on homewares, you could expect the shares to go off. But what's really impressive is that actually that it didn't fall that much compared to, and it's recovered a lot. I mean, it's not for a consumer brand, it's not that far off from its sort of like 21 highs, is it? Which is just shows the resilience of the business.
Yeah, no, not at all. I think air fryers, that was another thing that really drove a sudden
Yeah,
surge in
that's right.
demand at
Air
one point. Yeah,
fryers.
but all sorts of stuff. But no, they have recovered. They haven't been hit as hard as some others. And as you say, they've really, if you look at the charts since the IPO, they're kind of back on the trend
Mm,
from pre-pandemic now. And I don't see any reason why they can't continue to deliver some nice incremental growth. So
yeah.
yeah.
Good. Okay. Well, let's again just finish on the consumer. This is more of a sort of like a cost of living crisis beneficiary. Is Telecom Plus that does I think owns the utility warehouse that does all sort of like sells utilities as to lots and lots of households and has quite a unique model where I think it's got a sort of referral model that people become, if they're customers, they can then refer their friends and stuff like that. It was an absolute darling at the when Ukraine, I think, invaded. It then sort of topped out, say, £24, come down a lot now. Dividend yield, I'm guessing it's cash generation, nearly 6% dividend yield. But so to take us through the view on
Yeah,
this one, because presumably it's a pretty good business. This,
it is really unusual because at its heart it's basically a multi-level marketing business that
yeah,
they don't advertise, and you can actually sign up directly on their website, but it's not something they seem to push. Generally, customers are all recruited through a network of self-employed agents, and if you're an agent, you can sign up other agents and you can build your own network. And I think that's for the agents, that's quite a good way to make money. But when you say it like that, it doesn't sound like a likely candidate to be a 1 billion FTSE 250 business, but it is, and it's been around for more than 20 years, selling electricity, gas, mobile, broadband. It's now expanding into insurance, and these are all sold often as a multi-service package, face to face to customers. And the company says that does give them an advantage because of upselling from a conventional utility. Upselling extra services isn't such an easy sell at all. And I think if you sign up to all the services, you get everything through one bill and you get slightly better pricing. But I think what behind it all is they have a long-term energy supply agreement with E.ON, and that's enabled them to be one of the cheapest, or possibly the cheapest, energy supplier in the UK for quite a lot of the last couple of years. Because what happened, as you remember, we've seen a lot of these small energy companies that popped up over the last decade. Now they've all failed and gone bust, haven't they? Really, and
yeah,
you're left with about half a dozen decent-sized businesses. And during that period, when there were all these really cheap fixed-rate deals, Telecom Plus didn't do as well. They weren't quite as competitive. But what we've obviously seen since then is that these cheap these cheap deals weren't
yeah.
sustainable. The companies have all imploded, and now Telecom Plus has really reaped the rewards of that. They've stayed disciplined and stuck to their model, and now it's really quite a competitive offering. I
Mm.
think customer growth is running at about 14% annualized so far this year. Pre-tax profit was up about 25% in the first half. Because they're just a reseller, it's a pretty capital light model, although they've had to spend a bit more, I think, on customer service and IT in recent years. But they expect to get up to 1 million customers in the current financial year, and they say that that still means that that's only about 3 out of 100 households in the UK. So they reckon there's a lot more room for growth.
Mm.
Um, as you say, it's really derated. Funnily enough, the founder, Charles Wigoder, who's stepped away from the business really now, he sold a big chunk of his shareholding at £24. And that was really, I think, a classic case of signaling the top. That was really as good as it's going to get for a while. But I think at about 15 quid now with a 5 or 6% yield, it's pretty reasonably valued if you trust the track record and believe the business can continue to do what it's done for the last 20 years. So
what's the customer service like? Because I guess that's really the sort of the winning differentiator in this sector.
yeah, I mean, I've never been a customer, so I don't have any first-hand experience. What I know is that they have spent quite a lot more money upgrading it over the last few years, and I think some of that may have been possibly there might have been some feedback from the regulator, not just to Telecom Plus, but maybe to a number of utilities that prompted that. But I think it's, you know, I guess it's good enough. They seem to have quite a lot of people seem happy. You know, people
Yeah.
the retention rate I think is quite good, and they're continuing to attract new customers. So I guess they've probably got that reasonably well covered now.
Okay, good. We've got another one from another question coming in from Matthew Roberts asking about Me Group, which I think is the old photo booth, Photo
Yeah,
Me
Photo Me.
business.
Yeah,
Have you ever had a look at this one? I think it's a similar sort of cheap business. I think.
yeah. I did own it for a while, and it's yes shot up recently following the recent results. It's another one of the things. It's where you look at the business, and for years and years, people have been saying, "Well, that's not going to have much of a future." Photo booths, you know, smartphones mean that photo booths will become redundant, and you won't even need them for passport photos and so on. But it doesn't seem to have happened, and they obviously have upped their game in terms of technology, and there are still some advantages to taking a photo in an official setting rather than trying
What
to do
happened
it
here?
yourself.
What happened here? We just sort of rocketed, hasn't it, at the start of the
Yeah, I
year?
think that was just there was some results just 22nd of February,
Wow.
and they were quite positive. I'm not sure.
Yeah, that's probably the
There's only
understatement of the day, isn't it?
yeah. There's not been a huge. I think broker estimates haven't gone up all that much. Looking at the consensus numbers, they've only gone up by well, 5% or so, maybe off the top of my head, but it was quite a positive commentary, I think. And it's another one of these businesses that when it's going well, it's very, very profitable and throws off a lot of cash. And there've been some big special dividends in the past as well when cash has built up too much. So it you know it's been quite volatile over the years, I think it's fair to say. And obviously the pandemic was a really tough time, but they're expanding into new areas. I think self-service laundry is very popular in Europe, especially. The photo machines still seem to have a market here and abroad, and it's another business we seem to be talking about a lot of them that's still controlled by its founder, who owns, I think, about 36% of the shares. So maybe there's an underlying message there that when things are tough and something's out of favor, if you've got someone controlling it who has a lot of skin in the game, it does improve your chances of a recovery. But it's another business, good balance sheet, good profitability, and it's been more durable, I think, than people expected a few years ago in terms of the core business.
Yeah. Well, it's good. I don't know if you can see can you see the margins here at all, or is it a different screen?
No, I can see your screen. Yeah.
Can see my screen. Yeah, but can you? Is it? I've got basically the financials for. Yeah, it is brilliant. I got the wrong one last time. Sorry about that. What was quite impressive with Me Group is the margins are incredible, aren't they? And it pays a 5% dividend
Yeah,
yield.
it's about a 22% operating margin, and kind of, I think last year's accounts showed something like a 30% return on capital employed. So although they are investing a bit, it's the plenty and about 20 million in net cash too. So there's not really, I don't see much risk to the dividends and to continuing to increase the payout.
Yeah, good. Okay, well let's switch gears to another sector because we've got a couple of questions coming in. Is the financial asset managers have been absolutely battered, and I know you've got one on the sort of the radar screen. It's Impax Asset Management, which I think is a specialist fund manager in all things environmental. I think sort of green, energy, decarbonisation, etc. And if I'm guessing the shares haven't done so well because this whole area has had sort of a drip feed over the last 2 or 3 years. It's been hit by the passives, and it's not doing too bad. Sort of a drip feed of or compression of fees and outflows as investors have redeemed, from active funds. But what's your sort of your latest on this one? Because I think the whole sector is pretty cheap.
Yeah, the whole sector's, I mean, it's pretty out of favor. And when you look at Impax, the shares are down by about two-thirds from the end
Yeah.
of 2021. So it's taken a big hit. But I think one of the things I like about this, again, it's a founder-led business, but I think it's one of really quite a small number of asset managers in the UK that is genuinely differentiated. And for me, that's something that's going to likely to be more important with active management in the future rather than less. And so they say they what they specialize in is investing in the transition to a more sustainable global economy. So it's not just an environmental thing, and definitely not just the kind of ESG box ticking exercise, but they look at businesses, they say, with good governance, good business models that can benefit from and drive the transition to a more sustainable economy. So looking at their flagship investment fund is called Impact Environmental Markets, and that's about 30% of assets under management. And a lot of these businesses are actually overseas companies, a lot of US companies and some European ones, but they operate in areas like water treatment, design software for manufacturers, clinical waste management, heat treatment for steel parts, renewable energy, all this kind of thing. So it's not just a green play in the simplistic terms. It's more of a holistic way of looking, I suppose, at how the global economy needs to develop and in a more sustainable way, but while maintaining the kind of modern standard of developed living. I think one notable UK company that they hold is Spirax Sarco Engineering, which is another really high quality compounder that's done well. It always looks really expensive, but done very well over a long time.
Well, one question in terms of the potential benefit for the business, I'm guessing, is there's a huge amount of infrastructure investment and also alternative asset and also private credit going into green, decarbonisation, electrification of the world, the energy transition. Presumably, for an active fund manager, which you want sticky capital, i.e., sort of like people put you put these investments to get long-term returns. But presumably these guys are in a perfect conduit to be a benefit of that trend, as money wants to get sensibly placed into this huge energy transition.
Yeah, I think you could be right. And they're actually, I think Impact's also moving more into fixed income, which could possibly play
Yes.
to that sort of theme as well. So I think they have a good model for me. They have a good model for long-term sustainable active investing. And it's by the standards of asset managers, the dividend yield isn't that high, but it's still about 5.5%, and it's well supported. The business generates kind of 30% return on equity and operating margin, something like that. So it's really derated hard a long way. But I think that all else being equal, it's in a better place than many others to differentiate itself and to continue growing in the future.
Yeah, I like it. I think it's great. I think it's exactly the right spot. Okay, there's one question coming in from Revs8, and he wants us to know your latest view, if you've got a view, on Jupiter, which is, the Jupiter Asset Manager, the fund manager guys.
Yeah.
Now, I understand I don't know if that's the right one. Let me just, is a ticker Jupe? Is it? Yeah, it must be Jupe, isn't it? I'm guessing.
I think so.
Yeah. What was
Jupiter Fund Manager.
Yeah, what this has obviously struggled over the last few years, and then I think it also had one of its rock star fund managers deciding to go to somewhere else just recently.
Recently, yeah.
Yeah, but I mean, you look at that, and it's been one way traffic, isn't it? But I'm guessing it's got a really big yield. I don't know if you've ever had a look at this one, because I think it's the poster child for all things cheap, I think, in the sector.
Yeah, I mean, this is actually a perfect counterexample, really, to Impax. This is the flip side, I think. Pretty much quite a generalist active manager with a broad range of strategies, but not an obvious differentiation, I would say, in many respects. It's the payout, the dividend has actually really been has been slashed, really cut over the last 3 years. It was 17p in 2021, and forecasts for this year are down to 4.6p. So there's a lesson in not chasing the yield
Yeah,
too much there. Yeah, Jupiter is obviously, it does look very cheap relative to assets and on a PE basis, but I suppose I can't, it may well recover when, if the general market recovers, these things usually, I can see some upside for this, but I don't see the same strength of argument for future growth as I would looking at Impax.
yeah,
So I'd rather pay a little bit more in terms of a PE multiple for Impax than take a chance on Jupiter. But having said that, it looks really bombed out, and it could well perform well if the broader market conditions improve, I guess.
yeah, yeah. The dividend's been halved, doesn't it? You're right, and you do wonder what its competitive edge is in this difficult market as assets continue to transition to passives. I suppose is
Yeah,
that's
because
his biggest Achilles heel.
it's not particularly big. If I was going for a general asset manager in the UK, I'd probably look at something a bit larger, possibly.
Yeah.
Although someone might choose to hoover up Jupiter, I don't know.
Yeah, no, you're right. Yeah, yeah. Well, there's a lot of M&A going off in that sector.
Mm.
What I own, which I think just I've talked about before, is Premier Miton, which is people might want to have a look at. Again, it's very very cheap. It's got a big cash balance. It's come off a long way. The reason why I quite like this is that it's effectively a geared play on the actual market, and it's all active, and it's very much boutique and has an edge in its small cap sector rather than actually the bigger further upstage. People will know synonymous with Gervais Williams. So if people want to invest in all things small cap, this is a good way of actually getting into it and getting a position. But likewise, it's very cheap. It's got the market cap is Premier Miton. I'm not sure what the market cap is. I
Yeah,
think
it's about
I think
90 million, I think.
90 million. Yeah, but it's got a big level of cash on there as well, so they can invest, and that be another one people might want to look
Mm.
for. But it is difficult. I think the big picture is that if you've got an asset manager like Impax that has a lot of stable sort of funds under management that have long term, then you're going to get fee. You can see great visibility. But if it's an open ended type asset manager that you can get a lot of redemptions, then it's clearly been absolutely battered. But if those flows do change going forward, then they'll do very well, I guess. But you've got to decide, how do you want visibility, or do you prefer sort of like something a bit more with a bit of beta edge.
Yeah, I mean, I quite like Premier Miton too. I think one thing, their investment performance seems to be better than some of the asset managers. They say 75% of their funds are in the top two quartiles. I think assets were up slightly in the first quarter of their financial year, which was the final quarter of calendar 23, with market movements, I think, outweighed the outflows. So there was an overall positive move. Yeah, I like you. Quite like the small cap focus and the kind of boutique nature of it.
Yeah.
The yield is 10%, but it's still just about covered by earnings. If they hit forecasts, and if you look at this as being the bottom of the market in terms of sentiment and the market cycle, then as you say, these stocks could be really cheap and they could deliver a nice recovery. But yeah, Premier Miton, I agree with you on that. I
Yeah.
think.
Well, it should be certainly. There's no need to raise any more money, put it that way. Okay, we've got a final question from Steve Waters. He's asking about Keyword Studios. I don't know if you've ever had a look at this one. It's a sort of like I think it's a service business in the gaming industry. So it does all things sort of customization and sort of like for gaming. But clearly, it's been through the wars. Actually, it hasn't done too badly. Actually, I was expecting it. I thought it would perhaps worse, but as you can see it a bit worse. But I don't know if you've ever had a look at this business. It was a darling. It did a buy and build strategy And obviously, when we were all locked down, the gaming industry was going boom time. Reached the topped out at about £30. It's down below 15, so it's more than halved over that period. I guess now currently is people are worried that will gaming come back as people have started to, or quite some time now, sort of go back to experiences, i.e. come out of lockdown. And then also, I suppose, the impact of potential AI when it comes to customizing games, sort of like doing the dubbing and the visuals, whether they're going to be needed as a third party, intermediary.
Yeah, I think I've been quite impressed really with the progress of this business over the over the recent years. It does seem to it was quite acquisitive, and for me that's always a potential risk, because executing these things well repeatedly is not something that companies always manage. But I've had quite a favorable impression of this. I think all the gaming stocks pretty much have been a bit battered over the last year or two, or at least a great many of them. But I think in terms of things like AI, I suppose the view I'm taking, rightly or wrongly, is that even companies that are using this to automate work that's done by people, the AI will still need to be managed. It will still need to be trained on good quality bespoke data if you want a high quality result, and things like this. So I think service companies like Keyword Services should be able to adapt and still offer attractive commercial propositions for their clients. So I don't think it's the kind of thing that will be wiped out, although it might well face some changes in the way in the way it operates. But yeah, no, it's another business that looks quite reasonable to me at the moment. If you believe the growth story, and if you think it's still got legs to, still got way to run, then
yeah. How would you view? It's got a good cash flow yield. Inherently, it's generating quite a lot of cash, but it doesn't play a dividend out. How would you view that? I mean, typically, I would say that's sort of like investing in the business, but as a dividend income investor, how would you view it?
Yeah, I mean, it's not a share that I'd be
Yeah.
likely to buy for because there's almost no yield. But like you say, when you look at the
EBITDA.
balance sheet
Yeah.
and the cash flows over the last 5 or 6 years, for instance, there's been a lot of movement in net debt, and they spend quite a lot on acquisitions, I think. So for a company that's still expanding in that way, it probably makes sense to keep hold of the cash. They believe this is, like you were saying, I think at the start, really, they believe clearly that they can deploy that capital effectively to expand the business and to generate attractive returns. And if you're on board with management and you share that view, then it makes sense for them to do that. It's like the old Warren Buffett argument that he can deploy capital better than the rest of us, so he won't pay a dividend. It's whether it's having that confidence in management and hoping that they'll recognize when it's time to change the mix, maybe when it reaches a more mature scale or market share, because I think that sort of thing always tends to happen eventually, and if it's not well managed, it can destroy quite a lot of value before it becomes before it's acknowledged. But when it is well managed, it can be a nice transition from growth to sharing to returning more capital.
Yeah, I think with the actual business, you look at the estimates here, and you've got top line growth of over 10% organic, and you say if the company gets anywhere near that, then the shares are going to re-rate because the price just doesn't reflect it. So if the consensus is correct and they hit those numbers, then it'll do really well. But equally, and it may not, if it doesn't hit 10%, it may not fall a great deal, because clearly there's a lot of sort of like, skepticism in the market about whether they're going to achieve it, I guess.
Yeah, I think so. I think it's
all right, great. Well, thanks very much, Roland, and well, look forward in touching base in the near term again. So thanks
yeah.
again.
Thanks, Paul, and thanks for all the questions as well to the viewers.